welcome back to another episode of the Lenders Gone Wild podcast. I'm your host, Matt Maier. And grateful to be joined with friend and colleague, Michael Prieto. Michael, welcome to the show.
Thank you for having me, Matt. I'm doing great, man. Thank you for having me today.
Awesome, man. Awesome. So really cool that like our paths crossed in this business, but our families actually knew each other from before we got into the mortgage and lending side of the world.
Yeah,
which
absolutely.
is wild. Like, for a few years, we didn't know we were running in parallel spaces.
Exactly, we didn't know what each other were doing, and it's crazy. I think that speaks to the importance of truly networking and getting connected with those around you. So yeah,
and salespeople, right? Like my bad, he didn't know I was a lender. That's 100% on me, right? So all of you LOs out there, no one in your world should not know what you do.
Yep, and he didn't know that I help loan officers capture more business. So bad on me. So
But you know. The daddy-daughter dance is when the daughters aren't really hanging out with us. We should have been talking about doing some loans.
Exactly. Yeah. God, I love those memories.
Yeah, good times, right? Good times. So thanks for being on the podcast. Love to just spend some time telling your story, understanding a little bit about your journey in the lending and mortgage world. Here is, this massive opportunity that is real estate, right? Sometimes really... can be a little overwhelming for people or intimidating, and buying a house or buying a first house especially. So before we get into some of what you're really passionate about and I'm excited that you're doing now, tell me just a little bit about your journey. Like, how did you come into and grow in this business? How long have you been in the mortgage related industry?
Yeah, great question, man. I spent about 18 years in the mortgage arena.
Okay.
Fell into the space after my time in the Air Force.
Okay.
I was military police, and I thought, you know what? When I get out, I'm gonna be a cop. That's really what I thought I was wanting to do.
Sure.
And then I realized pretty quickly, like, I like my weekends and holidays off and my nights off, and knowing that industry, I'm not gonna have that right away. And so I fell into...
Seniority takes a while, right, before you get to enjoy those things.
Exactly, yeah. Seniority takes a little bit. But, so I ended up, moving out from Texas to Arizona.
Okay.
And crazy story on how we even chose... My wife and I chose that, chose Arizona. But right after the military, came out here and was looking for work and found myself with an opportunity to go into, mortgage lending. And being bilingual, I thought, moving to Arizona, I actually thought I was going to lose my Spanish abilities.
Yeah.
And quite the contrary, right?
Sure.
I use it a lot out here. And that actually got me the job as a loan officer, as a bilingual loan officer for a small company. And that's where my mortgage career started. That was back in 2006.
Okay.
And I was with a smaller company, and we rode that 2008 craziness.
Sure. You got in and then survived the almost immediate crash. So what was that like as the new guy on the block? Like, right?
Yeah.
Like,
it was actually, as the new guy on the block, I didn't really feel much. I was working with first-time home buyers, really in the manufactured home arena. So the crash really wasn't impacting that arena as much. And so, I really didn't feel much difference. I was like, we're only doing government loans with entry blue collar workers and $100,000 price points. So it was just more about like just helping a bunch of families in that kind of southern manufactured home belt of the country.
Sure.
So a lot of Alabamas and Floridas.
So you're all over the country with this adventure, not just in Arizona.
Not just in Arizona. I was based in Arizona, but licensed in all those.
Got it.
Doing business in those states. And
we weren't licensed yet.
Yeah, exactly. Yep, you're right.
That was before
right.
We needed that extra step in credentialing.
I remember getting my first license for the state of Washington and failing the initial test and then going back 30 days later because I think you had to wait 30 days and then going back and passing it and doing just fine because that was one of the first states that was really pushing it. And so that's where it started. Eventually, got to a point where moved on to a different mortgage company. Okay. Spent 12 years with that one company. That's where I really learned and grew through the industry. Got to spend time in processing and leadership there, in loan origination, of course, so even in underwriting. Both
sides.
Yeah,
That's
even in
great.
Underwriting. So all three sides, if you will, origination, processing, and underwriting. And a lot of it, 98% of it, was still in the manufactured home arena. So like manufactured homes, the affordable housing, the first-time home buyer, the folks that need a lot of us, the blue collar workers, the fixed income folks. That's what where I really gravitated towards and spent a lot of my career and learned a ton, and learned a ton about defaults and foreclosures and all that crazy stuff that goes on in the world behind the scenes, right? And then at some point moved on to to get out of the manufactured home arena, and learned, like, my mind was blown when I left that company, because I went to a larger national lender call center environment where I was learning things like the conventional loans and appraisal waivers that I was like, wait, what? This exists? And then it was like, game on.
There's no appraisal waivers with FHA out of man home.
Exactly, yep. So it was like a game changer, like eye-opening, that, wow, I've learned so much up to this point, but yet I still have more to learn.
Sure.
And so essentially finished out my mortgage career once I was kind of recruited out of it, to get into what I'm doing now, and I've been doing it for almost 2 years.
Okay, so license, origination, have a background in process underwriting. So you've seen the operational side, you've seen the fulfillment, you've worked on the origination, a variety of platforms. What was the draw to AHA?
The draw to AHA was the fact that I could take a product and not only focus in on the team that I was working with, because I did a lot in the sales manager arena where I had a team of loan officers, right? And I could see them, help them grow, help them build their business, and that was what I really loved. I loved seeing those guys be successful.
Sure.
Taking them from a point of whether they're just getting licensed and giving them my all, whatever I could give them to help them succeed. And then thinking about the fact that, okay, I can leave this arena and now I can touch loan officers across all retail, all broker channels across the nation.
Not just the ones that worked for your company.
Exactly.
Yeah.
And so I was like, wait a minute, this could be really big. And I love seeing loan officers be successful, and now being able to tap into that and get calls from loan officers every so often where they're like, Mike, this is a game changer program, man.
It is a game changer program.
Yeah, and I'm like, I am so happy for you. Yeah. You've helped more families this month than you ever have, and you've originated more volume than you ever had. So just seeing those wins is just what really kind of drives me.
Got it.
Yeah,
I love that. So, right, when you look at the wins, what's the end? What's the arrival fallacy aside, what is the thing we're chasing to achieve as an ultimate objective for you and the team?
For me personally, it's really trying to reach as many loan officers as I can in the immediate business that we have at our fingertips.
Sure.
And we talk about legacy a lot and things about like what do I want people to remember me by, and I want to get to a point where, with me being able to tap into so many folks across the country, like, I really just want to be that guy that they remember, that, you know what, he helped me, build my business or succeed, or I learned this from him. And so that's kind of really where I personally want to get to, is where I can capture that many more
influence,
people. Influence.
Right? Like having that influence, like, manifested in creating significant impact and change in people's lives, right? Not just the loan officers, but indirectly the families that those loan officers are serving, right? Because obviously, right, to just tell everybody what AHA stands for.
AHA stands for Attainable Housing Advocates.
Okay, right? So love that last word.
Yep.
Right? Like, the attainable part, right, especially as affordability has become such a central piece of the headlines regarding our industry for the last number of years, right? So it's, what are we doing to create paths?
That's right.
And then coaching people down them, right? Not just shiny objects, go sell it, but like truly having that advocate piece of the title is so evident in working with your team, but also I think so crucial to homeowners and probably where you see some of the biggest impact. Is that true?
Yeah, that's totally true. You hit the nail on the head, Matt. Like, the making homeownership attainable is part of our company name as well. In that we not only want to make it attainable, where we get people into homes and have them stop throwing away money at rent,
sure,
but we want to make it sustainable for the long term. And so we believe, that through additional financial mentorship that they get through our programs, like we're not just, getting them into homes and wiping our hands free of them and saying, okay, good luck on your home ownership journey. No, our team stays with them and mentors them and talks to them about stuff that you know as well as anyone. Nobody's talking about budgeting, emergency savings. Nobody's talking about keeping up with the Joneses or why it's important not to keep up with the Joneses.
Right.
And so that's all stuff that they learn. And so, yeah, you're right. That the legacy piece does extend from the loan officers that I'm immediately impacting across the nation to the families, the hundreds and hundreds of families that they've now helped get into the program.
Yeah, well, and then creating equity, because a lot of times people are like, oh, DPA, right? Like they think about it and it's like, it's not a DPA. so tell me a little bit about what it is like from a program, like without, we're not selling to loan officers here, right? Like there's a lot of various people that are probably tuning in. So just like as simply as you can, talk about what is unique about the program to create that attainable housing that we speak of.
Well, first, I think we touch on real quickly on what a DPA is. DPA is down payment assistance that typically comes with, in most cases, comes with a higher interest rate, comes with a potential second lien or something that they have to pay back, and almost traps a homeowner into, okay, you're a homeowner now, but you're kind of stuck for 3 years, 5 years, 10-year lien, whatever it is, right?
Yep.
And then the loan officer has to go through all these hoops to jump through to even get that assistance. Where we differ is that, to your point, it's not a down payment assistance program. What Attainable Housing Advocates, what we do is we administer a program for a social innovation research project called HOPER. And HOPER is an acronym, just like AHA is. And we all know loan officers love their acronyms,
yes,
right? We have a bazillion of them in our arsenal.
DTI and LTV and all sorts of fun things.
AUS, all that good stuff.
All of it.
But HOPER stands for Home Ownership, Promotion, Education, and Research.
Okay.
And so, unlike a DPA, buyers enroll in the program and they are educated up front.
Sure.
They earn some income for being a part of the program, and then they're mentored post closing, which is that's the key piece that where we connect with families and we stay connected with them, so they get mentored. And through the program, there's a mechanism that also provides some additional monthly savings. And between the savings and the budgeting techniques that they learn in the mentorship, what we're seeing is a wave of clients, because as part of the research project, we also survey them twice a year.
Sure.
And so it's so powerful and encouraging that when I get a survey that comes back that says, thank you, AHA, and my loan officer for getting me into a home. I never thought I'd be a homeowner, but now I'm a homeowner with $5,000 in reserves or $6,000. And that's unheard of.
And I'm not, to your point earlier, trapped by payment, right? Which, especially as rates have gone up, right? We've seen that even amplified in a lot of the down payment assistance program offerings that are traditionally pushed and sold to the marketplace, right? And there's some really good ones that do things for people. I'm not saying that those aren't ever the right resource, but I think there's a lot of times they're sold without full understanding and representation, right? And
that's right.
And also restrictions. So like there's an income cap, right? With the DTI cap and right, debt to income. So right, so now I can't make more than this, right? But if I have any other debt with where your rates are, it becomes really challenging to fit. Like you're threading needles a lot of times, unfortunately, right? Which isn't the objective. Is to create home ownership, right? But sometimes some of these other restrictions, to your point, make it really challenging. So what ends up happening is every agent out there says you can buy a house with zero down. Every loan officer goes, you can buy a house with zero down, and then 4% of the people qualify, right? With the phones ring, right? And unfortunately, that becomes like the negative stigma around the down payment assistance world.
That's right.
Right? In that it's being utilized in the marketplace by a lot of people that I see all the time. Advertising things that are not proprietary as if they are, advertising things that are, look at the shiny object that everybody loves, but, you're going to pay for it eventually or immediately, right? In some cases. So when I first saw HOPER, I was like, this is so different, right? Because it's it's sustainable. Number one. Number two, interest rates are market FHA interest rates. They're not this ramped up, highly leveraged because we're taking the risk and you have no skin in the game type of rates.
Exactly.
So, how did it come to be though? Like tell me a little bit. I've never asked this question. Like, where did Hoper get birthed out of?
Yeah.
And how did that come to be something that AHA has the ability to go bless the marketplace with?
Yeah, great question. So the founder of Hoper built the mortgage company, sold it after about 22 years to private equity, made a small fortune with that transaction. And he understood, much like I actually did when I was in the underwriting and processing arena and kind of behind the scenes, he understood that there is a problem with people living paycheck to paycheck. There's data that shows, and as we've launched with over 100 lenders across the nation, like chief compliance officers, underwriting departments, they're like, guys, you hit the nail on the head. Like if we were to pull our FHA data and look at the default rate, there would be something called what's called a mortgage default bell curve. It looks like the shape of a bell. And that happens during the first few years of ownership. And interestingly enough, there's an inverse relationship between the propensity to default and the amount of savings that a buyer has in the bank.
Yeah, interesting.
And so the programmers really birthed out of the idea that you cannot, as lenders, you're looking at their assets, you're looking at their income. And I personally, in those 18 years I did lending, like I put people in homes that I knew were living check to check. And quite frankly, we're going to continue to live check to check because I'm maxing out their DTI, but I'm making them a homeowner, right? And that's where the sustainability word that I like.
Unless AUS calls for a month of reserves,
then
we don't need a month of reserve.
We don't need a reserve.
We can get a gift. We can get the 401k.
Bingo.
Right? We can tap every resource out there just to shoehorn you in at 47 over 57. If I get that green AE at the top, let's roll.
Let's roll, exactly.
And that, like, that's the world and the way that
by no fault of the loan officer.
Right.
That's the world you live in.
Yeah.
But your hands are almost handcuffed in the idea that, wow, there's nothing more I can do for this client to help them get better. I can make them a homeowner, but how sustainable is it going to be? And those are the ones that will typically, they've got less than $1,000 in the bank within those first few years. And again, going back to the chief compliance officers and underwriters, they agreed it's not the job loss, it's not the life event that creates the mortgage default. No. It's the lack of savings. Because when they lose their job, they have to make a decision. Do I pay my car or do I pay my house? Well, the car is probably going to get me to my next job, so let me pay that and then let me default on my mortgage for a little bit to get caught up. But interestingly enough, after you get to about 4 or 5 years in that mortgage, your default rate starts to go down. But if you look at the data, their savings are a lot higher by then. So maybe they figured out the budgeting. Maybe they got 401k money with their employer by then. But gosh, 5 years to get them out of that to get them into a more safe zone. We wanted to try to do it year one with some mentorship and a mechanism to drive savings in their bank.
I love it.
Yeah,
that's so good. So, how much can you share about how you do that?
Yeah. As much as you want me to share, Matt.
Let's go.
Let's go wild on
we
Lenders
got time.
Gone Wild.
Let's go.
So how do we do it? So Attainable Housing Advocates, we administer that program through Hoper, and we connect with the loan officers that have clients, FHA clients, right? It's going to be any FHA, get this, Matt, purchase or rate and term refi.
Yeah.
So like
do
the
you have property restrictions?
The only property restrictions are going to be condos and homes that already have existing solar systems on their roof. Those are going to be the two kind of ineligible property types.
Okay. So manufactured homes, back to your
homes are good.
First love.
Yeah, my first love was manufactured, and we've helped plenty of manufactured home buyers with this program.
That's great.
Yeah, single wide, double wide, triple wide, doesn't matter.
That's so good.
As long as it's FHA eligible, right?
Sure.
I just spoke to a lady today, in fact, out in Ohio. She bought a duplex with our program.
Okay.
She's living in one unit, renting out the second unit. She got her amount was full $13,000 that she used to buy her rate down.
So there's a maximum that you will give? Like what is the
that is the max, yeah. 13,000 is the max. So every buyer, every client purchasing will earn 3.5% of their home's purchase price, up to $13,000. And then on a refi, they earn 3.5% of the home's value up to $13,000.
Oh,
Yeah.
Interesting.
Interesting, right? Yeah.
So, like, in theory, your person that bought 4 or 5 years ago has a bunch of equity. This is a way that they could refinance, maybe to a low rate, depending on exactly when they bought, but
and get $13,000 for participating in the program.
Even if their house isn't worth that slightly north of 400, 400-ish, basically.
Yep, 400.
Right, just shy of 400.
Exactly.
Wow.
Yeah. Or think about the buyers that bought last year with a DPA.
Yeah.
Well, now I've got, as a loan officer, I've got $13,000 that I can pay off that second lien, get them out of their high DPA interest rate, put them in a normal FHA rate.
So the catch is you have to do the, right? I mean, you have to do the surveys, you have to do the education, right? You have to be willing to participate in the data gathering that is so critical, I think, to continuing to create attainable housing, not just through this program, but whatever the evolution of this will be.
Exactly.
What else?
What else they have to do is essentially they have to agree to the pre-closing education, like we talked about. They agree to the post-closing financial mentorship, and then I mentioned a few times through our conversation we help them with a mechanism to drive savings into their bank. Right.
Yeah.
One of the largest monthly expenses that people have is they've got their mortgage or their housing. Auto loans are typically high up there on the scale, and then it's monthly utilities, specifically electricity.
It's getting worse.
It's getting worse.
Every 6 months, it seems like.
When I'm doing realtor lunch and learns and talking with groups of loan officers.
Well, you're all over the country, right?
And I'm all over.
You're dealing with California.
Exactly.
I mean, there's some places that it's getting worse in Arizona, but it is a lot worse already in a lot of other states.
I'll ask a group of 50 or 100 people, loan officers, real estate agents. I'll say, at what point, raise your hand if you've ever received a letter from your electricity company that says, great news, next month your rates are going to be going down. And nobody raises their hand, right? But if I was to ask, have you ever gotten a letter that your rates are going up? I mean, hands go up through the roof, right? And so we're trying to address that problem there, and that's what creates the kind of sustainability. So instead of the buyer, because what's going to happen, loan officers are going to get folks into homes without Hoper, and 6 months later, somebody's going to knock on their door trying to sell them a very high commissioned, high financing fees solar system as a second lien on their home, right? And that becomes a problem when they go to sell or if they want to refi, because then you're dealing with UCC filings, second liens. Real estate agents don't really care for that transaction. Well, with this program, we've eliminated all that. We've eliminated the high commission. We've eliminated the secondary financing fees. We've eliminated the second liens, because the loan officers now, as part of the program, they get to finance the cost of a solar system into the first lien mortgage. So you're using
solar wind technology guidelines from FHA.
FHA solar and wind policy. And
Okay.
the loan officers that really understand that piece, that's like, wow, I mentioned earlier, originated volume goes up, right? So now all these loan officers that have done 4, 5, 6 of these a month now on average, those are the ones that are calling me saying, Mike, my originated volume has skyrocketed because of this program. I'm like, and you've helped all these families. Now those families have a fixed rate, great rate mortgage. They have a far reduced utility bill. And they're able to get some mentorship. And the idea is like, okay, now instead of, we'll use SRP and APS because we're in Arizona, right? So instead of them paying SRP or APS, $300 a month, that might be low, but $300 a month, now they're only paying them $100. So now our mentorship is like, okay, you're saving $200 on SRP and APS. What do you do with that? Let's put it in savings. High yield savings. Let's build your emergency savings account. Let's get you to a point where you're 3 to 6 months of your mortgage payment. Then we can talk about other things like vacations and stuff like that. Don't blow this money on a car or vacation. Emergency savings, because something might happen in year 2, like the data historically tells us, and you don't want to default on your mortgage. And so once loan officers grasp that, they're like, oh my God, like you, it's a no-brainer, game changer. Do
you stack other energy efficiencies or just solar?
It's just the solar and wind policy is pretty clear that it's just the solar that they actually have wind technology, but I don't know of any windmills that are out in Arizona or across the country that would be a part of the program right now. But apparently you could probably do some windmills.
Okay, so maybe so if the parts of California, right, in the desert.
In the desert,
right,
maybe.
By India.
We don't have any windmill installers on the program, but we have plenty of vetted solar installers that are part of the program that that have agreed to the research project pricing on their solar system. So the buyer gets a better deal on their system. They get this incentive.
Yeah, and even with the tax break going away, right? Big Beautiful Bill undid that. But at the end of the day, there's still a pickup, and they finance over 30 years. So the impact, especially, and that interest on that higher amount, there's a little tax deductible savings in there, right? Like you get a little bit of lift in a number of places without having this massive
you're in
cost.
You're in effect making your electricity bill now tax deductible.
Essentially.
Yeah, because you're not, instead of throwing it every month to the utility company, you're throwing a little bit more into your mortgage, higher interest 1099 that you're getting at the end of the year.
Yeah.
And so it's a win-win.
That's really cool. That's really, I mean, and really creative. I think kind of ahead of its time, right? Like this has been around for a minute. It's gaining a ton of traction, right? Because we're becoming more and more comfortable with solar, right? Understanding alternative energy type stuff, and then on top of it, right, the industry needs that attainable piece to be in place.
Yeah.
And so you're solving. They have to come up with their own down payment, but you're able to help them replace that in savings with, right?
With their monthly savings, or, some loan officers will take this money or clients and replenish their down payment with the program.
Exactly.
Yeah, so it's like an example I use is a young lady in California. She had a 401k. She depleted her 401k to get into a home. Like it wasn't much to begin with, but it was zero at the end.
Yeah.
She took the Hoper incentive,
put it back,
put the $13,000 back into her 401k. She's a homeowner, going to get mentored, and has some savings. Yeah. And not to mention more savings coming forward with the lower utility bills. But
so good.
I love that story. Like, what DPA program out there is going to let you put the money back into a 401k, let alone give you the money at closing? Like, it's insane.
Yeah, that's really cool. And you have to pay it back.
You don't have to pay it back.
There's no 3-year clock that's ticking where you owe some portion of it back to whoever.
Yeah, there's no clock. There's no liens. Like, it never has to be. We have loan officers like, wait a minute. I can streamline refi this guy in a year, even though they used Hoper? Absolutely. And they'll never have to pay it back.
Amazing, right?
So, yeah. They can sell. They can refi. There's no repayment terms of the money or anything like that.
Oh, that's beautiful. And I just think it's an education game now, right? Like my background being a teacher, right? Now it's like, how do we get more people to know about this and be able to put it to use, right? Because I do think it has a ton of power in our marketplace. And the FHA loan limit's probably going to go up again in a couple months. We're continuing to see there's an absolute opportunity here for families to be able to accomplish a lot in their financial lives.
Yeah, for sure.
Because at the end of the day, right, I've said this for a long time, and there's probably some financial advisors and definitely some crypto people that will argue with me, but over course of history, nothing creates wealth like real estate. That's right. So what you're doing to impact people's lives without putting them in a leveraged position, hoping it works out. Right, is really, really, really powerful. So
totally,
I love the work you're doing, man. Thank you for being out there waving that flag and championing people and homeowners and equipping loan officers and making an impact. That's really cool.
That's awesome, man. I really appreciate it. And I'll continue to do it. And appreciate you having me on the show. Yeah.
Any fun stories? I mean, you've been doing this for a couple of decades. Anything to share? Hey, we run into this, or you should have seen that, or let me tell you about that one time.
I mean, some crazy stories like stuff I learned on the foreclosure side, like when I was dealing with learning that piece of the business, was like some of the crazy stuff that people do to their homes when they foreclose and they leave. I've seen cement dumped into toilets. I've seen all equipment ripped off of every type of thing you could take. Like anything that's not attached to the home, like they're gonna take with them. It was pretty insane to see the pictures and then understand this is why, in that department at the company I was at, this is why we go after those guys to try to work with them to get the payments, because we don't want to end up in a situation where we got this home that's just completely trashed.
Once you go through the cost and the pain of foreclosure itself, then you still have what am I getting and how fast can I sell it, and will it go at auction, and it's just
It's insane. It's wild.
Yeah.
And but yeah, that's probably some of the wildest stories I've heard on
Sure.
like home quality and what's going on with it. But I think about all the stories like just now shifting from mortgage to attainable housing, and the when light bulbs go off for loan officers on the program, like it's just insane.
That's great.
And so I love seeing the creativity that loan officers have. You've had some guys on your show that talk about, not being called mortgage loan officers. They like mortgage advisor.
Consultant. Right?
Consultant.
Yeah.
I've heard. I used to use mortgage practitioner a lot
I love
because
Yeah.
like you really have to kind of figure out what's in front of you and put all the pieces together, right? And so I love the practitioners, the advisors, the consultants.
Advocate is a great word.
Yeah, that's a great word too. But the ones that do that are the ones that really thrive and like truly help families, and it's amazing to see.
Yeah, I've seen it my whole career.
Yep.
Right, the guy who's chasing a check or a transaction or an award, and some of those guys, they have long careers.
Yeah.
Most don't. Right, most end up in some sort of compromised leverage position, or all the guys that were in the game when you were. I don't know how many people, when I got into mortgage like 12 years ago, people that I talked to, they're like, oh yeah, I was, right?
Yep.
03, 04, 06. Why'd you get out? Rules, compliance, right? Like they all bailed.
Yeah.
They all just bailed. And it was like, oh, got it.
Yep. And the ones that...
The purpose is different.
Yeah, exactly.
Right? Because it was an absolute Wild West cash cow.
It
that
was.
Anybody could, with enough hustle and want to, could come make a lot of money in that 03 to 06 window.
Yeah.
Like it was insanity.
I heard.
Yeah.
I
was actually an insurance salesperson. I was doing life insurance and annuities.
Okay.
I had a 6 and 63 in my life health license. And overnight, our branch turned one of our offices into our mortgage processing center.
Wow.
And was rolling all the reps with all the NAGAM loans and all that. Like you couldn't take money out and invest it. That was still illegal, but you could take all that savings from making that NAGAM payment and you could open a life insurance policy or, right? Like there are people that were trying to do the thing, but the vehicle at the tip of the spear was built wrong.
Yeah.
Right? But the counseling, the idea, right? The free up cash flow, right? Create the emergency fund, create protection for your family, do these other components of a healthy financial portfolio. That I think was the right idea. The vehicle that everyone was depending on to open those doors without creating some of the education and behavioral change was a big piece of the problem.
Huge.
Right? And here's the problem. You would have people that go, yeah, I qualify for the 15-year payment. I'm going to keep making the 15-year payment. I'm going to do this, right? Until it came time to write the check in 2 months, right? And it's like, wait, I can pay $1,500 or I can pay $400, right?
Yep.
The interest is $1,000.
Yeah.
But so $400 sounds like a good choice.
Yeah, exactly.
Right? And then fast forward a year and like
we're in trouble.
We're in trouble. 120% loan to value, NAGAM. Like it was a horrible time.
Yeah.
And the fact that like my office could turn into a mortgage branch overnight was a huge, and that's why we have licenses now.
Yeah.
Right. I think Dodd-Frank probably overcorrected a few things, but for the most part, I think in general, people are in a better place because of the requirements we have. Like
I don't know. You could probably ask some loan officers historically, like if they feel different about this. But I feel like I was probably lucky enough to just be in the government loan arena, fixed rates. We didn't no adjustables. We did no conventional. It was all FHA and VA.
Yep.
And so that's where my career started in that 06. So while all these guys are doing this, for lack of better terms, we could say crazy things, right? Like I was just in there learning the business on government basic loans and just cranking out the units because you had to at $100,000 loan amounts, right?
Yeah.
So So yeah, so I hear the stories and I see it and I'm like, wow, that's
yeah. You weren't really
wild.
part of it. You were in the game, but
Yep.
you were kind of adjacent in that niche arena that allowed you
Exactly.
to kind of miss some of the really. I mean, the stuff that was being pushed, wild. But you know, the industry learned, the
That's right.
marketplace corrected, and we move forward. And I think what you guys are doing is so much more sustainable and done right to create that for people, right?
Yeah.
Like you're looking at the whole picture, not the transaction, and we need more of that in our space.
I love it.
So appreciate you, brother.
That. Appreciate
Thanks for
you,
being here,
brother.
man.
Thank you for having me, man.
Thanks.